So, a couple of days ago, I was talking about acquiring the right investment psychology, and in particular, how if you want to ride out a bull market, you need to keep dosing up on knowledge that reinforces the bullish thesis. You've almost got to delude yourself or keep reinforcing the belief. And on that note, I enjoyed listening to Bloomberg's Odd Lots podcast last week, which had Goldman Sachs metal strategist Nicholas Snowden. Now, as I've mentioned before, the recent price action in metals has cast doubts into my mind as to this secular bull market, and I needed geeing up with some bull food. And I came away from the conversation wanting to buy as many metals producers as I possibly can. So I'm just going to summarise some of the main points of the conversation. And here's the key one. By the middle of this decade, we are forecasting the largest ever deficit in the copper market, said Nicholas Snowden of Goldman Sachs. 2 years away from now, that is, 2.5, 3 years. By the end of the decade, he's talking about the largest ever long-term deficit. It is just an impossibly tight future. And when I hear stuff like that from randos on the internet, I tend to call BS. It's usually sensationalism, clickbait, and my instinct is to filter it out. But when it's coming from respectable employees of respectable institutions like Goldman Sachs, the implications are rather different. So let's start with the recent correction in copper prices. That was caused, says Snowden, by weak Chinese demand due to their COVID lockdowns. There were also higher than expected exports from Russia. Anyway, both of those are transitory, he says. The longer-term bull market is underpinned by two factors. First, increased demand due to decarbonisation, net zero, all the electrification of everything is going to require a lot of copper, and there's no obvious substitute. Second, there's been a chronic lack of investment in the sector, which is a drum I've been beating on this channel for a long, long time. But it's nice to hear it endorsed by that same view endorsed by a Goldman Sachs analyst. Demand for copper this year is going to come in at around 24 million tonnes. Okay, of that, about 22.5 million is normal copper demand, construction, wiring, and so on. Only 1.5 million tonnes of demand is green, decarbonisation related. That's to say for electric vehicles, electric vehicle infrastructure, and all the rest of it. By 2025, that green demand is going to double. By 2030, that number is going to be 6 to 7 million tonnes. So 24 million tonnes copper demand now is going to go up to 30 million tonnes, 6 or 7 million tonnes of new copper demand. Green copper demand, in other words, is going to rise from being 5% to 20-25% of annual global demand. Where is the extra supply going to come from? Production's set to increase slightly this year, but then it flatlines after that when it needs to rise to meet the new demand. Now, in the bull market of the noughties, as Snowden observed, projects were approved fairly quickly, investment flowed, and supply caught up with the new demand, which came from China mostly with its huge infrastructure program of the noughties. It's different now. Over the last 2 years, even though copper demand has doubled, there hasn't been a single new copper mine approved. Now, that's what he says, but I can't believe that's true. I've done some research, I can't seem to find out the information, but maybe there hasn't been a significantly sized copper mine that's been approved. The number one constraint on the copper mining industry, however, is the experience of the last cycle. Because the mining industry faced a near-death experience in 2013 and 2014 as a result of the overbuild in response to high prices in the noughties. Now, says Snowden, there's a much more conservative mentality amongst management teams in the mining sector reflecting that experience. Now, I remember that experience. The memory of 2013-14 lingers, crike, not just in my mind, and we won't forget it in a hurry. Maybe we will with higher prices, but Snowden calls it internalised trauma, and it slows down investment. Meanwhile, the permitting process, largely for environmental reasons, has got a lot slower. What would take 6 to 12 months to get permitted now takes 2 to 3 years. Chile is the world's largest producer, But it's also one of the hardest places to get a copper project going. And that slows investment, as does the ESG influence on investor allocation. Less capital goes to mining because it doesn't score well on the ESG filter, on the ESG ratings. Again, it's another observation we've made on these pages, particularly as regards oil and gas. The talent factor. Mining is hard. Who wants to work in mining, oil and gas, when you can earn more while risking less in tech? The gains are quicker and the aggro's lower. So as Snowden says, you've got a real bottleneck now on skilled labour in the industry. There aren't enough engineers to a project. And that puts upward pressure on wages, and from there on capex, and ultimately on prices. In short, painful memories of previous overexpansion are holding back investment. Opening mines is harder because of increased regulation, and there's a shortage of people. And we come now to substitution. There's no other obvious substitutes for the metal. Substitution using something other than copper might look like a solution. Other metals conduct electricity too, but for example, there are practical issues with that too. Aluminium requires more space. So, if you want to build something that requires a small amount of space, aluminium's going to be no good, and aluminium's got its own supply issues. Pretty much every base metal does. It's not particular to copper, all of this. There's also the fact that the incentive to substitute is low. The cost of the copper content in, say, an electric vehicle, it's a small part of the overall cost. So the copper price would have to go really high to motivate change. You can make similar observations about tin and silver. There are just tiny amounts of it in everything electronic. That's why they call them the spice metals. Higher prices will solve a great deal of this. Mining will be incentivized, investment in alternatives will increase, technological advances will reduce the amount of raw material required, recycling and scrap supply will increase, tailings get reprocessed. But I don't think there's like a shale gas moment for copper on the horizon, some kind of breakthrough technology that rapidly improves productivity. And even if there were, it's mining so slow, it'd still take probably 10 years to implement. And copper needs to go to a price that incentivizes all of this change. And it's currently $9,700 per tonne. Snowden's saying $15,000, but he doesn't rule out that it could go to $50,000 or $100,000. I remember at the peak of the last bull market, people were melting down coins, theft was everywhere, a bronze statue got stolen and melted down. We're not at that point yet. As Snowden, using a baseball analogy, says we're still in the first innings. I think there's 6 or 7 innings in a baseball match. I hope he's right, because I'm long copper and copper producers. But, the situation is looking very, very bullish for copper, because we know this demand is coming and we don't know where it's going to be met. There's all sorts of ways you can invest in copper, futures, ETFs, in individual companies. If you go to my Substack channel, I'll put a link in the page. I'll spell out all the ways you can play the copper price, either without taking individual company risk or through large caps or even a couple of juniors. But yeah, thanks very much for watching. Please subscribe to the channel. Please subscribe to my Substack, and go copper, I hope. And speak to you soon. Cheerio.